Hello fellow traders, Philip Tigerson here from Stock Market Strategy. This video is part of our day trading strategy series, but this is not a trading system in itself. In this video, I'll teach you about support resistance specifically for day trading. This support resistance can be used for both entries and analysis, and I will show you both. But before we continue, I want to remind you to watch the previous videos. The one where we talk about how these videos is more for inspiration, so you can design your own strategies, and also the video where we talk about the general tips in day trading. Now there's two kinds of support resistance. There's the one that is tested, and that's the one where it's not tested. If a support has been tested, there's been a previous bounce on that area, so we know for sure it is a support. That doesn't mean it will hold, but there is an increased odds that it will. In the situation where we have tested support resistance, you can enter with a limit order with a small stop. I will show you this later. Or you can, for example, use candlestick patterns. If you're interested in candlestick patterns, we suggest watching our video we created here. Just click on this box. When the support resistance is not tested, we recommend that you wait and see what happens, and I will show you what I mean by that. Or you use candlestick patterns if it occurs at that area, again because candlestick patterns give you a small risk and a potential big target. Now support resistance can also be used for analysis, and that is if price have broken support resistance, can often create a trend change. And I will also show you that how we use support resistance intraday to give us a bias. Now there's three different support resistance intraday we look at. There's the prior day high low, there's the overnight high low, and then there's gap support resistance. I'll show you all these three and how we use it. The first, prior day high low. That is yesterday's high and yesterday's low. They often act as support resistance. Here you see two different colored lines. One is cyan and the other one is pink. The cyan is yesterday's low, the pink is yesterday's high. These support resistance that I've written here is not tested. It means we do not have a previous bounce on that area. But that does not mean we can't use it for anything. Here in this situation, we come back to prior day's high. That is why this line is drawn in here. This is automatically drawn in TradeStation. But you can see how it comes back and tests prior day's high and bounces from there. This is not a tested support until we come down now and test it and bounces. One way to trade this could be the candlestick patterns, or you wait and see what happens to see, do we really bounce or do we just drop right through prior day's high. Over here you can see that we have a yesterday's high, which is then resistance because we're below it, but we come above it and below again. You can see here that again it was not tested, so we want to wait and see what happens in this area. It comes up, breaks right through like it didn't even exist, and then down again. So this was a fake breakout. But we wait and see what happens because it's not tested. Again, we have another not tested support down here, which is yesterday's low, the cyan color. But you can see how this still works. We just want to wait and see what happens at those areas. You can see how a simple line drawn in from yesterday's high or yesterday's low will be able to give us some sort of an idea where we can go long or short. So I really do recommend keeping an eye on prior day's high and low for support resistance. Now I want to show you what we use prior day's high low for as well for analysis. Here you see a nice uptrend in the market. There were several opportunities to go long on those pullbacks or even a breakout new high intraday. And how is that? Why did we have a trend day? One reason could be because we break 2 days prior swing high in one move. These two lines are prior day's highs. And when we gap up and continue to rally, we're breaking away for 2 days high in one move. Here you see another nice trending day. And why is that? It could be, I'm not necessarily saying that's the reason, but we use this for analysis ourselves. We can see we take out 2 days prior low in one move. When we open here, we quickly drop below 2 days low and we continues down. So this is what we use support resistance for as well for analysis, not only entries in itself, but also to give us a bias. In the future, I will make you a video where I show you what we use to determine whether we should be long or short intraday. But this is just to give you a heads up about how to use support resistance for analysis. The other support resistance level we look at is overnight high-low. Here you see yellow dotted lines. They give us the overnight high-low. Here you see a bounce at this support giving us a tested price level. That means we could go long with a limit order. Let's assume you went long with a limit order here. You have a small stop and you get stopped out. That's simply just part of the game. You will not only hit winners in trading. Here you see another high-low overnight. And we can see how we're hitting support several times, so it is tested. Thereby you could enter a limit long down here and you would have made profit. So you would have made your loss back because your loss is small here and your target is big here. So you might make 2 to 1. So even if you have 1 win and 1 loss, you still make money. But this is how we use tested support, and in this case there was even double support. We had the overnight low and we had yesterday low. Remember, support resistance is zones, and that is exactly what we're getting here, a zone. We don't only use the overnight high-low for entries, we also use it for analysis. And the same goes here. We have a nice move down. And why is that? Well, one reason could be we take out a triple low at overnight low. So because we take out all this support, price might be able to trend and drop significantly, and we can get a trade on either flag patterns on the downside, retracements up, whatever. But what we use this for, this overnight low and the triple bounce that fails, is we use it to give us a bias to go short when it's taken out and we get some trending market. As mentioned earlier, I will make a video in the future about how we get a bias intraday, whether to go short or long. The last support resistance we look at for intraday is the gap. Gap fills can often act as resistance or support, depending whether we gap up or down. Here you see 2 gaps. You see a gap up here and you see a gap up here. These are both not tested. That means we do not have any prior bounce at the gap fill, so we do not know if the gap will really hold. One way we could use this is we see a nice hammer here. And if you want to learn more about hammers or other candlesticks, we recommend that you watch our videos on that. But you could have entered on this hammer and you would have been stopped out. It is just part of the game in trading. But again, you have a smaller stop than your target, so you only need a 50-50 hit rate and you will still make money. Down here we see another gap fill, and that is not tested either. What you could do is you could use this little base here to go long when you see it starts forming support. How do we see that support forming? Well, first thing is that we see several bars next to each other. Price is no longer dropping or climbing, it's forming a base. We're also seeing a hammer here showing that buyers are coming in and pushing price up after sellers try to push it down. So this gap fill here from over here acted as support and we did bounce, and that could have given you a trading opportunity. This is just to show you that it's important to look at support resistance, whether it is prior day high-low, overnight high-low, or even gap fills. There's more to day trading than just looking at support resistance. We recommend only trading when the charts are clean. That means no big volatility bars. They make it difficult to trail your position. They also make it difficult for you to get a proper risk to reward. We also recommend not trading around holidays because volume could be lower. We also recommend not trading around Fed announcement or other major news. These Fed announcement and major news often create those high range bars that makes it difficult to trade. This ends this video. Have a good day.